Welcome to the Techno Fundamental Report for October the 5th. It's always darkest before the dawn, and I'm talking here about sentiment. You know, human behavior has a way of getting to extremes, and with pessimism and optimism, you have to realize that when everybody gets pessimistic, it's probably meaning that they may be out of the market and they're sitting in cash. Therefore, there's a lot of cash on the sidelines. So once the markets turn, it can be quite rewarding. Now, you also have to have the sense to get out of the rain. And this power index that we have recommended that you keep an eye on basically measures the rate of change for the last 6 months or 125 trading days of the 5-year Treasury yield. Now you'll notice here it's quite obvious that interest rates are in an uptrend. And the rate of change over the last 6 months has been roughly 34%. So in other words, over the last 6 months, the 5-year Treasury yield has gone up quite a bit. So it is creating the problem here. So as we take a look at sentiment, this is the sentiment readings from the AAII bull-bear ratio. And when we're above zero, it means that people are optimistic. When we're below zero, they're pessimistic, and they're pretty pessimistic right now. So pessimistic that they're going over to Costco and they're buying gold bars. You know, Buffett talks about gold. I think this is an interesting situation here. In fact, Costco sells out of these gold bars the minute they come in. Buffett says gold gets dug out of the ground in Africa or someplace. Then we melt it down, dig another hole, bury it again, and pay people to stand around guarding it. It has no utility. Anyone watching from Mars would be scratching their head. So gold is kind of a non-producing asset. It's a fear asset. So when people are aggressively going after gold bars at Costco, it's telling you that there's quite a bit of pessimism. Trying to catch a falling knife, that's just not a good idea. If you look at Boeing, I had a friend the other day ask me, he said, I've been wanting to buy Boeing, and if it went below $200 a share, that he wanted to buy it. And I said, don't do it. I said, that stock is in a downtrend. I would leave it alone, and I would allow it to base first, because you don't know why is it in a downtrend. There's got to be a reason. The downtrend, what you have to understand about this downtrend is, and this is a pretty definite one, you got more sellers than buyers. So every single day, you got more sellers coming in than buyers coming in. So if you think that you can come in there and somehow turn this thing around, well, I wish you luck. But the point is, avoid downtrends. Look for uptrends. Here's some more examples just to make the point. This was a company we were looking at one time called Dutch Brothers. They have coffee shops that are drive-through. Downtrend. Now, you could say, well, I'm gonna buy it on this breakout, and then it drops, and then it drops, and oh, it's cheap now, I'm gonna buy it. So you can see the problem. Now, this is Canopy Growth. This was the old marijuana stock. It's done nothing but go down. It's basically trading at zero. CRISPR, this was a big tout. This is a biotechnology situation. Again, it just continues in a downtrend. Has a great story. I mean, the story is fantastic, but the stock, there's just more sellers than buyers. This is Dollar General's. You would say, gee, Dollar General, pretty safe. I don't know. It looks like to me it's in a pretty severe downtrend. So my point is that price is where the rubber meets the road. This is a listing done by J.P. Morgan. This was a 24-year study from 1980 to 2014 of what they call mega winners or historical winners list. You can see most of the mega winners are primarily growth stocks. I mean, we're talking consumer discretionary, staples, technology, so forth. So what I'm saying is for these stocks to make this study, the reason they made the study was because the price of their stock went up. So if you really boil it down to where the rubber meets the road, it's price performance. So, that's where technical analysis really comes in, is where you're looking for these uptrends. Now, just to kind of bring you up to date on what's going on with the market, you can see the advanced decline line for the NASDAQ. It's not pretty. It's in a really steep downtrend. Again, we've got a very narrow market here where just a few stocks are acting well and a bunch of stocks are not acting well. A lot of new lows, no new highs to speak of. So just be aware of that. Now, the new lows minus the new highs, I mean, quite dramatic here. I mean, we had this big drop this week. I want to say that was on Tuesday. On Tuesday, we had the over 400 point drop. You can see that the new lows are definitely outweighing the new highs. So it means be cautious. The market just doesn't look that good. Now, as we look at the indexes, realize these are key moving averages. Now, the beauty of moving averages is that they level the price out. So you take out the daily activity and spread it out over some time. So the blue line is the 25-day moving average. The red line is the 50-day moving average, and the green line is the 200-day. So what we would like to see is to be above these moving averages, and the moving averages being in an uptrend, something like this here. But that's not the case. Now, if we look at the mid-cap stocks, now again, we look at 5 indexes because we think just looking at the Dow doesn't tell you the whole picture. You got to get under the hood a little bit here. Now, in the mid-caps, these stocks are smaller companies, therefore the interest rates will have a dramatic impact on them, and that would go for the small cap stocks as well. These are the mid caps. You can see not only have they broken below these 2 key moving averages, but it's also broken below the 200-day, and it's definitely in a downtrend. So if we look at the New York Composite, same thing. Now this has a lot of banks in it, and the bank stocks are just not acting very well. So you can again see breaking below these key moving average levels. This is the small caps. Now this is where the greatest amount of damage is being done. Last week I mentioned it as the canary in the coal mine. Until the small caps get into some type of stable position, it tells me that the market is continuing to discount problems. Here's the S&P 500. We're holding the 200-day, but it is breaking down. It is in a downtrend. Now, these are our 3 economic indicators. Again, you can clearly see the 10-year Treasury is, basically making new highs, got up to 4.8. Price of oil is kind of cooling down, but still in an uptrend, which is inflationary. And then we have the financial stocks, which are just continuing to break down below that 200-day moving average. We need to see strength in the financials as well. Now, this is the new lows on the New York Stock Exchange. Not a pretty picture. 440 new lows is the highest they've been in quite a while. So just be aware of the fact that there's just not a lot of stocks making new highs and way too many making new lows. I also wanted to point out this junk bond fund. Well, it's called the HYG, which is a high-yield corporate bond fund. This has been holding up remarkably well, but here recently it has really come down. So is the market starting to discount some type of slowdown? Because think about it, junk bonds, corporate bonds, people buy them to get the higher yield, but then if they start worrying about default risk, you can see that's basically what I think the market's telling you. They're worried about default risk. With the market dropping like this, there's got to be something going on out there that we're just not aware of yet. And if I had to issue an opinion, I would say the banks. I don't know how the banks are going to get, especially the regional banks, are going to get out of the dilemma they're in because they're losing deposits because people are fearful that they don't have the adequate amount of insurance, or the amount of, they just want to move their deposits to the big banks. Now, the energy stocks were looking really good here, then all of a sudden they're starting to break down. So, again, it just looks like to me that the market, and I put a trend indicator on here, you can see that the energy stocks have broken their uptrend, now going sideways, but could be the beginning of a downtrend. So the energy stocks are starting to show weakness. Well, look, if you have any questions, let me know. Thank you very much.